All right, Ford stock. A couple days ago, Friday, a couple trading days ago, Friday, it was on the most active list. It made the most active list because it had a high volume day on Friday, 150 million shares, I believe. Cash isn't open yet. It's 6 a.m. Pacific time, so we have a half hour to
List.
go. But anyway, Ford volume dried up relative to what it did on Friday. I did get involved, and what I was looking to do was to increase my position size, but that was predicated on the price of Ford going higher. Let's take a peek at what happened with Ford. 958. So from 958, it rallied up to about 990, a little bit higher, almost $10. And then yesterday, Monday, the 10th, it continued. I started to get involved. I got involved in the April 17th expiration, which now is 37 days away. But anyway, I started to dip my toe in at 20, price of 20 cents on the 10.85 strike. And I bought 10. And what I wanted to do is see this increase, and then between 20 and 30, I was going to pick up another 90 if I could at the right prices, somewhere between 20 and 30. So that way I'd be writing 100 of these calls out of the money expiring, and yesterday would have been 38 days away. So one of the things I might have done, had it gone up enough, I might have been able to, for one thing, create a three-legged box. So let's say that my average price on the 10s that I bought, the calls, let's say it would have been 30 cents. All right? And then I'm trying to create a box between 10.85 and 11.85. Now I can play a power chord here, so to speak, and have a two-legged box. Note that this would be a power chord. Imagine this is a fretboard, and let's just say we're playing a G power chord. So this is the third fret, this would be the fifth fret, and we got the G power chord here. So I could have had the two-legged box, creating it this way, but I would have needed a stronger move than had I played the regular 145 or 541 by purchasing a put spread on the other side, the 11.85, 10.85 put spread. Now, again, let's say that I had an average price on the 10 calls at the 85 strike, 10.85 strike, for 30 cents. So if I buy this put spread for 70 or less, I will create a synthetic position where I'm long the 11.85, and if I pay less, again, less than 70 cents, 70 or less, it would be free. So what I mean by that is, let's say that I bought that for 70. Now note that this spread, 70, this side of the ledger here, the 10.85 calls 30, so that equals $1, which is
Verizon shares
the length,
pre-market declined to more than 5%.
which is the length of the difference between these strikes of 11.85 and 10.85. So what that looks like on a risk graph would be the following. Note that, let me do this. It's going to have to be 10. 10. All right, so let's say I have an even number there. So I pay 70, and I bought the other side for 30, although right now it's 20, because that's all I have on the 10.85 calls. So I'd be free rolling, and I'd be synthetically long the 11.85. Now, is Ford going to go to 11.85? I have no idea. It could go to 10.85, could go to 9.85. It might not move at all. But the point is, what do you do with the risk once you have it on? And this is one thing that could be done. Now, let's say that Ford moved up enough so that I wouldn't need to sell that 10.85
Dollar
put.
yen rises 0.5%.
And let's say that this, I'm able to buy the 11.85 put for 70. I buy 10 of them. Right now I have 10 of the 10.85 calls. I buy 10 of the 11.85 puts. So I have a dollar wide box here. But again, note that this doing it this way, constructing it this way, where it's a two-legged box, power cord, so to speak, 4 would have to move up enough. But again, I would be left with a situation where I now have a two-legged box on, but I have 2 synthetics. I'm synthetically long the call from 1185 and synthetically long the put from 1085. This I would actually prefer to do because then I'm basically making a play on vol, So I don't care about the direction anymore. I just want it to move. Go higher, go lower. Don't care which way, just move. And if I do it for the right price, and by right price, I mean less than the difference, the width of the strikes involved. In this case, it would be less than 1. Then I can free roll, or I just have a credit on. Now, if I would have had 100 of these calls on, I don't necessarily have to do 100 on either side of the put side of the ledger, where I'm buying the 1185s or doing some sort of put spread. I can peel off some of the 100. Let's just say I sold 50 of them, and then I'm free rolling on the position, so to speak, so I have a bit more flexibility on the price of this on the put side, either just buying a put or buying a put spread, because the profits from selling off a piece of the original component of the trade provides me with more flexibility. So I'm I'm taking off some risk, harvesting some profit, and leaving myself in a situation where I can not only be free rolling for a credit at that, but I have a nice vol play. So either way it goes, I can make money, and if it doesn't go anywhere, I still make money because I locked in profit. So that's what I was looking to do. Unfortunately, the price of these calls ended up going down. Where were they? Let's look at Ford. And we're at the April 17th expiration. We go out 16 cents. 16, 17 cents. And I just jumped in at 20 with a 10 lot, looking to see what it did. I'm glad I didn't buy 100, because then I'd be losing money on 100 of these calls rather than only 10. So this is very reasonable for now. Okay, if it does start to go up today for whatever reason, then again, in my mind, it's going to be back in play, and I'm going to look to pick up as many as I can, probably cap it at 100, but we'll see what happens. We have about 20 minutes before the market opens, and I'll take it from there. All right, I hope that was helpful. Thanks for tuning in, guys. Catch you